So I just want to talk to you a little bit about the stock market versus life insurance, and why is a life insurance better in that realm? Why is it more secure? And so there's a couple of things. One, your life insurance companies are putting the majority, well, the companies that I work with, that's the only companies that I can speak for, but the companies that I work with are putting the majority of their money into bonds. And so when you have a huge bond portfolio that is professionally managed, you are going to get a better rate of return, you're going to get guarantees. We're not using variable bonds, we're not using crap government bonds. They are using secure bonds. These companies have been doing the same thing for 150 years, and it's worked, and they've survived. Okay, so we have to think about who's managing that money, where is that money being housed, what's being done with that money. Is that money I can take my own money and I can go buy a bond with it, but it's not going to be, I'm not going to get the same rate of return because I have one little bond compared to a mass amount of money being invested and professionally managed. And not only do you have people that have managed this money within these companies have survived 150 years. I cannot say that our Federal Reserve is equally as safe. I can't say that. And when we have to look back as well, where were pensions put? You know, we used to have pensions that you worked 30 and out. Now all of our pensions are falling apart. And when we look at the pensions, if they're not falling apart, they're underfunded. You know, I use the state of North Dakota as a great example. We have dropped significantly in the funding of our pension. And a lot of states are in a hurt bag. South Dakota is sitting pretty well. California, not so good. And so when we have underfunded pensions, well, it was a pension. Like, that is the whole point of a pension, is that you have guaranteed income for life. And that's not what's happening. Why? Because pensions used to be put into an annuity, into a life insurance product. And today they are invested in the stock market. So we moved the pension from the risk of the life insurance company and the risk off of the pension holder, off of the employee. The employees never had that risk before. We moved that risk from the company to the employee today, because now the risk is on the employee, because they're the ones that have their money in there. It's in the stock market. You are shouldering that risk, not like a life insurance company or a life insurance product such as an annuity, where that risk is put on the company. So when you have a whole life insurance policy, that risk is on the company. That company is not backed by the government, going to come in and protect them and save them. That's not what's going to happen. So you have that security that you don't have in the market. So when the market falls, you've got these ups and these downs. I work only with mutual companies, and what that means is that you are part owner of the company. I compare it to like a credit union, because credit unions, you're part owner of. When the credit union makes some money, you get just a tiny little bit back, right? So, or a co-op, for those of you that are farmers, a co-op. So now you've got money coming back to you because you're part owner of this company. The difference is that a dividend within a life insurance policy is not taxed. It comes to you tax-free because the tax code looks at it as an overpayment for insurance. So you want to work with a mutual company. There are companies that sell whole life that are stock companies. So a stock company means that the shareholders get the dividend. The shareholders have to be satisfied. They have to be made happy. If the shareholders aren't happy, nobody's happy, right? Well, what happens when your shareholders are greedy? What happens when you have an Enron type situation where the big dogs at the top took all the money? And so with a mutual company, you get the ability to vote on what's going on with that company if you want to do so. Most people choose not to because the company's been run for 140 years on their own, And so they can manage that. But when you're talking about dividends, a mutual company will give you a dividend. I have come across people that have whole life policies with stock companies. Not a terrible policy. Not the best policy, right? There's okay, and then there's, this is fantastic. What tool is going to maximize building that house? Do we need the hammer for the nail? Is it going to get us there? Or do we want the air gun? Right, well, air nailer. Because that's going to get us there faster. So what is going to get us there? And Nelson talks about that in his book. If you don't have Nelson's book, then you should get it, obviously. On page 45 of Nelson's book, he has an illustration of dividends versus no dividends, okay? So big, big deal to have the dividends. The other thing is that within the policy, there's really, it really comes down to three things for me. Liquidity, control, and guarantees. And I talked about this the other day a little bit, I believe, but we're going to talk about it again. Liquidity, control, and guarantees. Can you have liquid money in any other tool? Meaning, can you access that money without penalty? Like a savings account. Can you do that? Liquidity. Do you have control of the payback terms? Do you have control of that loan? Okay? And guaranteed. Inside the policy, there's guaranteed rates of return. Does the rate of return matter? No, it is not about rates of return, but there are guarantees. So liquidity, control, and guarantees. There is nothing within the market that can offer us the exact same thing. An annuity will have the guarantees, but you don't have the liquidity. Okay, so annuities are not a bad product. I rarely write an annuity, rarely sell an annuity, because it comes to you as taxable income. But it is that guaranteed pension because they are guaranteed for life. So there's some things about annuities that are very appealing. But where is it going to put us in our tax bracket down the road? Ideally, if we have a combination of everything, that's great. I personally think that I want everything in life insurance. If I have it there, I can pull it out and I have no money going to taxes. So if an annuity comes to you and it's guaranteed, fantastic, but it's coming to you as ordinary income. There is a new documentary, which I have not seen, but it is called The Power of Zero. There is a book called The Power of Zero, written by an accountant who understands life insurance. Now, in his book, he talks about universal life, which I absolutely 100% do not agree with. But at the end of the day, the message that he is giving is the exact same thing. From an accountant, if you borrow money from life insurance policies at retirement, it is not taxed because it's not income, because it's borrowed money. When we pull money out of life insurance, whatever we put in, if we pull that out, that is called basis. If we put in $100,000 and we pull out $100,000, it is not taxed. And it is not taxed because the tax code says life insurance is first in, first out. Whatever you put in first comes out first. Those are some things about why the life insurance policy is way more secure than the stock market. Liquidity, control, and guarantees. That is the reason that we're using this as the tool to the concept. The concept will work with a coffee can. It is a thought process. The tool to get us to the next step, the correct tool that will help us get there faster, is the life insurance policy, set up correctly. So it's a matter of looking at the big picture. Why are we using life insurance? What are the benefits of life insurance? And those are the benefits. Professionally managed money that is guaranteed a rate of return, dividends paid for 140 years. You get to be part of the company. That is why when Nelson talks about Becoming your own banker, okay? Becoming your own banker. That is not said because he's trying to be clever, okay? It's literal. He literally means you are becoming your own banker because you're going to own the bank. Nelson talks about in his book, starting your business. How do banks get started? He talks about that. That is because he is comparing that to the advantages of buying a life insurance policy. The business is already started. The legal's already there. Everything is already there. You just have to buy the policy, and you have some startup costs because it's like starting a business, right? You have some startup costs, which are AKA death benefit. So are you going to make a bunch of money right away? No. It's long term. If you're not in it for the long term and you can't see the long term, not the product for you, not the concept for you. If you can't see the concept, if you're not open-minded to learning that and understanding what Nelson is teaching, might not be the concept for you. But that's what we mean when we say becoming your own banker, is you are now part owner of the bank. If you buy a life insurance policy from me, guess what? We own a business together. And we get to decide if we want to vote or not. And that is the difference between having life insurance versus a 401k or an IRA or something in the market, some sort of mutual fund, a 529 plan. It doesn't matter. Life insurance can be used for all of those same things. If you need anything, let me know. Otherwise, thanks for listening today and have a great day.